I think I've learnt more about UK property in this one hour than all those years I spent in the UK. Very, very interesting. Thank you, Mark, for that. I'm just going to give Richard an opportunity to wrap up the presentation before we go into Q&A. And I think what's interesting, given the dynamics of financial markets, I think a lot of this could be applied here in Kenya. You would have thought that it would make sense for the government to be doing a lot more of this itself instead of owning these buildings outright out of interest. But Richard, can I allow you a few seconds to wrap up before we go to Q&A?
Absolutely. Thank you. I've got some quite good partners, haven't I? I know nothing about property. Okay, guys. Risk adverse? Can't hammer it home enough. Alternative investment? Hedge currency? Platform of a strategic portfolio? Something you can feel, you can touch, and you can understand. It's property. It's let to the government. I think St. Paul's will be a huge success. I know I'm talking my own book there, but I really mean it. I really, really do mean it. I think this provides, admittedly, not a very gigantic return, which a lot of us are used to, because we've been investing in this country. But it does provide a very solid and very stepped advance into the outside world, into an arena where I think we all probably feel quite comfortable. Thank you all very, very much indeed for your time. I think we probably overrun, but I've actually thoroughly enjoyed talking to you this morning. I dare say there are going to be quite a few questions and answers. I probably can't answer them, but I'll do my best, and Mark will help me.
So quite happy to take any questions. If anyone's got any burning questions. You got the first one? Okay, and then we'll take them off social media as well.
I'm Raphael Okoth from Speedlocks Media. Thank you very much, Mr. Richard Britten, for the insightful presentation. So I've got a question for you. In the property market, there's cutthroat competition. How have you managed to maintain a global footprint? And what are you doing right that others are not doing?
That's a very good question. Thank you. I don't think we're doing anything wrong compared to anybody else. You know, we're slightly in what I would call the institutional bracket of investment. So we're much more insurance, safe. The footprint is academic, if I may say so, because as Mark told you, the market in the UK for commercial property and government-occupied commercial property is huge. So maintaining a footprint, we're known, we're respected. We've been doing this for a long time. We have a reputation for doing just this and nothing else. We're very focused. Does that answer your question?
Can I just come in a little bit there? I completely understand where you're coming from. The actual fact of the matter is that we have been in this business for such a long time. I just told you we tracked about £1 billion worth of deals that have been taking place over the last 12 to 14 months. We have a little competition in the office, certainly between Nicholas, his son, and myself, on those properties. And I say to Nicholas, oh, I just got this one in Manchester. It's let to so-and-so. It's let to the Department of Trade and Industry, blah, blah, blah. Nicholas goes, yeah, I had that 4 weeks ago. You know, that's when we got it. We got it 4 weeks before the market. And we have a little competition with ourselves as to how much in advance of the market we can get those properties. People talk to us before they put the property on the market because they don't, in many instances, want to be seen to selling them. They want to do a quiet deal. You know, they don't want everybody to know their banks told them to sell it, so they want to shovel it out. So we get them early. Does that answer a little bit the question?
So I think that's really being in position. It's like market making, isn't it? People know that you're there in the market, so they come to you for a price, and you really are in the middle of the information loop.
I'd say that when we were running Witchford, when I was running Witchford, 85, if not 90% of the properties that we acquired, and that was £1 billion of property, was acquired off-market. Off-market. That means privately, from institutions who own them, and so we need to get out, or private individuals, or indeed banks.
Did you?
With your permission, can I throw just a small question, a 10-second question? And how do you manage customers' expectations?
Which customers? Because the main customer is going to be the government, right?
Yeah.
Yeah.
Do you mean our tenants?
Your
Or
tenants
do you mean you as an investor?
Yeah.
You as an investor. I manage your expectations because I will continue to give you feedback. We run a very transparent organisation. Everything is open. There's nothing hidden in there. You can see exactly what happens. We're going to have regular investor presentations in this country to show you exactly what we're doing. We'll have regular contact with you to let you know what properties we're buying. We'll let you know the dynamics of the properties we're buying and what we expect them to do. So we're there to be measured in a transparent way. We're not hiding anything. We're going to run it very much like a real estate investment trust in that way. But of course, we're a bit more efficient than one of them.
I was quite surprised when we went to see the CMA, the regulatory body here. And when I said to one of the heads of the CMA, we intend to use the disciplines of a fully listed London Stock Exchange company in the form of transparency, information, and indeed capital raising, I think they were extremely pleased. But that was because we wanted to do it on what we would call an international standard. So we will maintain international standards of transparency. Actually, I'm delighted because I want everybody to know what's going on. It's something to be proud of.
I've got a question from social media, if I can ask it to you. Would like to know why St Paul's PLC chose the IPO as opposed to an IREIT that may have tax exemption.
Thanks very much. I think it's a good question.
This is Edward, by the way.
Thanks very much. You preempted me. I was going to introduce myself on the assumption that certainly not everyone will know me here. I'm Edward Burbage. I run Burbage Capital, which is a Kenyan transaction advisor, corporate finance firm, and we're advisors to St Paul's. When we first started talking to St Paul's, we looked at all of the structures that we could use to offer this to Kenyan investors. The question about the IPO versus the REIT is a good one, but I think you can only have a REIT in Kenya if you're investing into Kenyan property. And I think it's fairly clear that this is investing into UK, very, very highly rated, but UK property. And so I think as Richard went through, the tax structures are in place. They're actually probably more efficient than a REIT.
And as transparent.
And as transparent, exactly, yeah.
And that dividend arbitrage, really, I mean, I remember, I'll tell you an old story, when I was at Credit Suisse, and the Italians...
That's a Swiss company.
Many years ago, and the Italians issued a bond which paid interest gross, but in order to buy it, you had to go to the post office in Italy. And this chap, very bright fellow, hired all these young Italians, and on Monday he sent them out buying this bond, and by Monday evening, the Italian government was calling up Credit Suisse and said, "What are you doing?" Now, your arbitrage sounds very much like that episode, that the dividend you're saying is fully paid back. I mean, no withholding tax.
It's not quite like that,
Yeah.
Khan, if I may say so. The dividends are from the surpluses. Sorry, the dividends arise from surpluses within the company, from post-tax or pre-tax profits, which are very much the same. There is no tax. It's just tax leakage, as I said, was very, very small. The dividends come from that,
Yes.
but they also particularly come from the profits which we talk about when a property becomes mature.
Yes.
What I thought, use that one which actually we own, Norman House. That's got 3 years unexpired on the lease. 3 to 4 years unexpired on the lease. It's a perfect example, actually. And we already know the government want to renew. And if they don't renew, we know Holiday Inn want to move in there. I'm not joking. It's actually worth more with Holiday Inn as a site than it is with the government back in there. But we won't go down there. But it's because I use it as the example. I think you said it's worth 1.6 million now, and it's probably worth 2.9 when you renew the lease and onto a nice long 25-year lease, but because the actual occupier is, although the occupier tenant is the government, the contract is with these people called Mapley, whose contract expires. So there's a default mechanism. So if we make a profit, or sorry, not if we make a profit, when we make the profit of about £800,000, most of that will go into the dividend account. I think I did mention this earlier. And that will be classed as a special dividend. And that, ladies and gentlemen, is another reason you do not buy this stock for the short term. You will miss out on the special dividends. You might be very happy with the 6 or 7% yield initial, because it's coming through as a dividend, but your special dividends, coming from those sort of profits, are what you're really going to make your money from. All right? Does that make sense?
Totally. Yeah, thank you.
Hello, my name is Moses. I want to say that I admire your experience in the UK property market. And on to my question, George Osborne has been known to be a biggest antagonist to the property market in the UK as he's trying to regulate the prices there. Do you see a near future where he might succeed in closing all the loopholes of buying property through these offshore companies such as Jersey and British Virgin Islands, so that he might even make purchase through such companies illegal and thereby regulating or rather slowing the growth of the housing property in the UK?
Good question.
It's a fantastic question, and thank you, Moses, for asking it. I don't legislate for government, and indeed, you don't legislate for our government here. There are loopholes which every government tries to close. So whatever I say in answer to your question, Moses, is subjective. The tax benefit of investors buying UK commercial property is very well established, not only in terms of what's called stamp duty land tax or stamp duty, but also for acquiring properties. If you remember rightly, we talked about special purpose companies underneath the holding companies, where there is a huge advantage, first of all, in buying the special purpose company itself rather than the property. You only pay 0.5 or 0.5% tax, stamp duty, like you do here on shares, because you're buying shares in the company. So wherever possible, you buy your property in a company, rather than paying 4.5% tax. Is it 4.5 or is it now more? In the last, we had the budget yesterday. I'm sorry, I haven't had a chance to look at it. I don't think it went up. But it's about 4.5% tax. That's the first point. But your question really, Moses, is will the government stop the loophole where people can buy through the British Virgin Islands or indeed the Isle of Man and have all the tax advantages? Yes, they could. They definitely could. And in the same way as the Kenya government could very possibly turn around and say, we're no longer going to allow you to pay no tax on your foreign earnings, which is what the situation is today. If you, as I explained to you earlier, this is why it's tax-free to us, all us guys here. The answer is, I think, Moses, it's highly, highly unlikely. Virtually every single foreign entity, every sovereign fund, they're huge, who've invested in the UK property market, has done it through tax-efficient structures. It would be devastating on the UK property market if it changed. I don't know the answer. I hope to God it doesn't happen, and I feel as certain as I can be that it will not happen.
Can I just jump in as well? I think the sort of loopholes that George Osborne's looking to tidy up at the moment are people in the UK who are investing in offshore tax structures to avoid paying tax in the UK. He's not looking to close down foreign investment into the UK and repatriation of profits to those foreign investors.
Much more eloquent.
It's the internal one that he's really after. So he's after me doing something through the Isle of Man, taking my money out there, not paying UK tax on it. That's who he's after. He's not after you as a Kenyan investing in the UK and getting a return back from it. That he wants to encourage.
Yes. Can I throw a question to you, Patrick? Because you've been obviously a pioneer in the real estate space here in Kenya via Knight Frank. You gave me wonderful amounts of information about the market here. You've got your finger on the pulse. You've got your finger on the pulse in the UK. Finger on the pulse all over the world.
The doctor, really?
Yes. What can you tell? What would you say about this opportunity, and what would you say about the contrast? Because
I think I'm here partly because with the latest grandchild, I think I can say I've known the Long family through 5 generations, starting with his grandmother, so we've all known each other. But yes, I do understand the Kenya property market as well as anybody, and I have maintained contacts, obviously through Knight Frank and other sources, with the UK market. The biggest single advantage when Richard Britten-Long asked me to have a look at it is this. I develop property here for clients, and the dilemma all the time is that we are probably picking up an initial yield, if including the developer's profit, of maybe 10%, but we're borrowing, I don't have to tell you, at 16%. So the limits of borrowing are very, very small, and the danger in the early years of developing property here is to run out of money before growth takes you away. Now, that has worked extremely well recently because the growth has been here and people have been able to retire their borrowings. I don't think we're in a bubble, but I do think that property markets are cyclical, and my guess is we've probably built rather more than we can immediately occupy. It's not going to stop the world. The sun's going to continue to shine. It will come right, but I would certainly have some short-term worries about my ability to get good tenants into buildings to service debt if I borrowed too much. If I haven't borrowed anything, it couldn't matter less, because long-term, the capital gains will be there. Now, when I look at this deal, you are buying a yield of between 5 and 10%, and you're locking in borrowing through interest rate swaps, I think, and you're borrowing at 2%. So it is the other way round. Your debt is costing an awful lot less than your yield. And that, to my mind, is the clincher for saying that this is a relatively risk-averse thing. I asked the question, where are the risks? The big one is non-renewal of leases. And I asked, what happens if interest rates go up? Well, the answer is they can see ahead 5 years through the swaps. If anybody who thinks they can see more than 5 years ahead, well, I think they've got a special access to the Almighty.
So what you're talking about is positive carry. You're saying that in the UK, the term is positive carry. Bond investors use it. It's where you're buying an asset which is paying you an interest rate that's higher than your cost of borrowing. And what Patrick is saying, that here, when you're a developer, typically you're borrowing money at 15, 16, 17%, and your return is around 10, so you've got what's called negative carry.
And then you've got to pay tax on that return.
Yes, correct. So that was the other point. Can I take some more questions? Any ladies that want to ask a question? Because I've become very gender sensitive. You're going to pretend to be a lady, Graham? Okay. Graham, did you have a question? Graham is the chairman of the British Chamber of Commerce, rather dynamic chap.
Yes, good morning, everyone. Yes, recently founded Chamber of Commerce, and I'm the chairman. And one of our mandates, just for everyone here in this audience, but I will direct the questions to the panel. I'm Kenyan born as well. My chamber, and the reason that I've taken on the role, one is obviously to handle the political gap between the two governments, but more importantly, to take the chamber and Kenyans to push Kenyans north, not receiving British companies south. So our mandate is to really push Kenyans north. And one of the reasons I'm here, because I think this is a good opportunity. My question, and maybe it's more of advice, there are 400,000 Kenyans in the United Kingdom.
Okay.
The diaspora worldwide are transferring about $100 million into Kenya a month.
Underestimated.
Underestimated.
Because, yes, we looked into that. Can I just quickly intervene on that?
By all means.
We estimate that 3 million Kenyans abroad sending back home an average of $100 a month. Yeah. And that also explains the strength in the shilling. Yeah. And also there is a number in the central bank accounts where they can't account for about $5 billion. And we believe that is the difference, the accumulated difference between this $100 $100 million a month and what is actually coming in. Sorry.
Very interesting statistics, but I think it's really worthwhile. But gentlemen, if there's the British 400,000, remitting whatever they're remitting from the UK to Kenya, is there some advice that you can give them on what they're remitting here and then reinvesting it back into the UK? Because obviously it's got to be some kind of tax-efficient way of doing it.
The answer is absolutely not. We can't give advice. We're not regulated to give advice. I'm sorry, Graham, I can see your question, but there's nothing called off the record, is there? If they do remit their sterling or their dollar earnings back to Kenya, there's no reason why they can't invest that through the buying shares in any company, frankly. But St Paul's, of course, being particularly sterling denominated, they're reinvesting back into the currency which they're working from, if it's sterling, not dollars. But yes, it is. It would be very risk-adverse investment strategy to do that. And actually, you're quite right. I mean, I'm very well aware of the number of Kenyans, including myself. I'm one of them. I'm one of those 5 million, to be perfectly frank. I remit my money back to this country as well, because I've got my mother living here and I've got my home here. But so I'm slightly in the same case, to be perfectly frank. But the answer is I cannot, and we cannot give, and we wouldn't dare give advice on that sort of thing. We're not regulated to do so, and you know how strict they are.
Introduce yourself. Yeah.
Truly, my name is Stan Klaus Agacho from Steward Capital. Steward Capital main focus is creating wealth, changing lives, because we believe when business succeeds, lives are changed. And in Africa, the setting is that one income equals 10 lives, depending on that. My question is concerning the mitigation of the risks that are eminent in the UK property management and the property market, and majorly three. Number one, I was looking at the Investment Property Forum report of 2015-2016, and they highlighted three things. And the first is that the UK economic growth is not as impressive as the forecast suggests, and the implication then therefore is that the rental rates will not necessarily swing upwards but might actually decline. They also highlight the second thing, that the over-exuberant investors purchasing a lot of properties for the sake of this styled kind of investments will actually push down the initial yield to under 5%. And thirdly, there is the risk of the UK government jumping out, of the EU in 2017. So these are three, in my view, three components of the model that really require a lot of mitigation, and I'd like to hear some of your mind concerning this. Thank you.
Certainly, as far as the rental growth situation is concerned, what we've had in the UK is a situation where rents in the City of London and the West End of London have exponentially grown enormously. We're well over £100 a foot there. Those rents are balancing down. The rents are coming down in the city, they're coming down in the West End. They are a big effector on the rents everywhere. Now, elsewhere in the UK, the rents, they say the rents are coming down. In fact, in the last thing, they went up by 0.2% nationally in February, according to CBRE report. But what's happening in the regions is there's been a complete stagnation. There's been nothing developed in the regions since 2007, 2008. The rents have sunk to 15, 16 pounds a foot. Economically, you can't build for that price. So there's been no new stock come through. There's been no refurbishments done. With what's happening now, the rents took an upswing, and they took the upswing in the last 18 months, and they went to 30, 35 pounds a foot. That was to allow properties to be built, to generate new properties, and they've stayed at that level. At the moment, they're staying at that sort of level. As demand builds and people want more space, then it'll go up, or if they don't want more space, it'll come down. But one of the most important facts in all these is employment. And employment is going up and up and up all the time. And if you actually look at employment, what do you need if you employ people? You need space. So I think, although our economic growth has slowed, and it's not as punchy as certainly the Chancellor wanted it to be for his last budget, which is why he put a sweetie tax on, it's still there. It's still growing, and we're still the best growing economy in our sector. So I think from the rental point of view and rental growth point of view, the regions will perform better than central London. That's why we're concentrating on the regions. But when you look at an average, it's obfuscated because you've got all of London in there as well. So it actually, when you look individually, you can see growth.
If I can tackle your last question, which is about the possibility of a Brexit and the uncertainties of Europe. I mean, I don't know. And frankly, I really don't know. I don't know which way I'm going to vote, and it's next month. And we're all supposed to be slightly sort of grown up and well-educated and make up our own minds. And it's one of the very first times, I'll be very honest with you, that I've actually, I'm hesitant. I don't know which way to go. Now, I'm a farmer as well in England, as well as Kenya, but I've got a really nice farm in England. And if I wear my Shamba hat, I would definitely vote to stay in Europe. On the other hand, as a financier and watching what's happening in London and the effect that it's likely to have on rental growth, I'd probably vote to leave. So I have a complete conflict of interest. Forget about my interest. What is the actual consequences? That's what you're interested in. You've already seen that to a certain extent. It's built into the price. Look what's happened to the Kenya shilling compared to the sterling over the last 2 or 3 months, where all the uncertainty. Look what's happened to it against the dollar. Look what's happened to it against the euro. And the euro is going through complete hell at the moment. You know, they don't know whether they're going to give more quantitative easing, and you're obviously extremely up to date on what's going on in the financial markets. But you know what I really think? I actually think that we will not leave Europe. Touch and go, but I actually think the consequences and the financial consequences to the UK are so substantial that we will not go out. And if we don't go out, the British sterling pound is going to rocket because it's already built into the price that we will exit. And if we don't exit, it'll go up. And that's another reason why actually by pure chance, it's an opportunity for us Kenyans to buy some pools, because we're buying it cheaper. But watch it, because I think the currency movement will go the other way. It definitely will if we don't have an exit and we stay in Europe.
It's rallied about 5 points from the low, which was about 10 days ago or 14 days ago, I think.
Because it's a movable feast. And there's everything in the papers, you read about it in the Financial Times or even on BBC or Sky. You know, there's so much debate going on. The market moves with rumour. And if rumour says that actually we're not going to leave, bingo, sterling improves. You have another question, I think.
Yeah.
I think I'm terrible. Just in the rare case, because your business model is based upon not purchasing in London, right? You want to purchase outside. That's the core of the business model.
That's correct.
Now, if you exited the euro, if you exited Europe, now what's going to happen is it is known that 70 to 80% of the main occupants of London are foreigners, right?
Well, then it won't matter, will it?
Totally.
Because they'll just bugger off.
So the question then becomes, when these guys back off, right, then there's a possibility that the rental price is going to fall slightly.
In central London.
In central London. Then people might leave our properties because I want to buy this, right? Now, guys might leave our properties in Manchester and Cardiff and come to central London, and then now we don't have rent.
Can I just, firstly, on all our models, we haven't predicated rental growth. We haven't actually said we expect the rents to go up. And the reason we haven't done that is because we deal in the present. We deal on what's here now. I'm not a speculator. I can't tell you what the rent's going to be in 5 years' time or 5 minutes' time. I can tell you what it was yesterday, and I can tell you what it is today, and that's the market I deal in. So I can't speculate as to what's going to happen. I can tell you that the chances of the UK government shifting its offices from Cardiff, Sheffield, Manchester, back to London is nil. There is no chance whatever of that happening. Social demographics in the UK demand now that they have to spread their load to allow employment in various regions. There are certain regions, there's one near Liverpool, at Bootle, where the main and virtually only employer is the government. They are actually under a government directive that they must not move from there.
Good point.
Because if they moved, it would decimate the area. So there are lots of other dynamics that go into it. But I don't, we're not in the business. If I could predict what's happening to rents with complete accuracy, I'd be on my island in the Caribbean now.
No, you wouldn't. You'd be in Khalifi.
Before I go back there, I've got a question from somebody on social media, Anne Kay. She's asking that, last year you were looking at gems. This year it looks as if it's that potentially it would be a full IPO. Would you care to just
I think it's Ed's answer.
tell us a bit about that?
I'm terrified of breaching all sorts of compliance issues here. So this is where I really bring Ed on.
Okay, thanks very much. And sorry that my role is the really boring temper.
You are really boring, Ed.
And so it suits my character, I fear. So I start looking, giving Richard a sort of evil eye at this stage when we start talking about offers and IPOs and market segments, because we value our relationships with the regulators, obviously, and so does St. Paul's. And I think the spirit that St. Paul's has shown is very much to engage with regulators with us to try and find what is the most appropriate legal structure for this offering. So I think at this stage that's still in discussion with regulators. Okay, and that's what my firm is primarily leading forward. I think the intention is that we will keep the market informed on what the decision is in relation to how the offer is done and how the listing is done. So I think, watch this space, and I think leave your contact details obviously as well, and we'll keep everyone updated, but we'll keep the market generally updated. But I think, you can assume that the structure will be the one that provides the most liquidity, the best corporate governance, the best disclosure structure, and the most solid structure for Kenyans to invest into this product.
Thank you very much. My name is Kireka Mwangi, and I was born in Kenya. Thank you very much for the fantastic presentation. About 10 years back, we had some investments in Australia, very consistent, dollar share price. Every 4 months, they send you dividends. But then what was happening in the stock market here was so exciting that we had to sell that off and just keep the money here, while we were getting very, very good return on investment. So my question for you is, in as much as it's very secure, very stable currency-based, when I compare that with our local property here, like for example, student accommodation, which is something we're into, we can easily give you 15%. So I think my suggestion is it possible for your company, because the model and everything is fantastic, is it possible for you people to do a property here and then give better returns in Kenya shillings?
I hope the point several times that I'm risk adverse. Now, I'm not saying that your investment into Kenya property is carried with or loaded with a huge risk, but I think it might be a higher risk than it is in the UK. Patrick alluded to this not being a bubble, and actually, if you're not leveraged, there's going to be no problem, and it'll be sunshine as usual, to quote him. And I think he's probably right. But why would I invest in a Kenya property to deliver 15% in Kenya shillings when I can invest in the UK, and if my model works and the profits I can obtain or deliver from selling those properties that mature as we renew the leases to give, shall we say, same 15%? The answer is, to me, it's a great deal less risky to follow my model. And let's forget, my tax situation is pure. It's seamless. Yours, if I did it here in Kenya and I went and invested my £50 million in Kenya, I've got to pay all that tax. And I may be risk adverse, but I promise every single one of the person in this room, I'm really tax adverse as well.
Just answer that question a little bit as well. I don't think anybody's saying that they don't want you or anybody in this room to invest in Kenya. That's not the case. We anticipate all of you investing in Kenya and continuing to, and getting the returns that you wish to get from that. What we're saying is that as you go forward, there is profit in having a structured portfolio. When you put your portfolio together, you don't have all your eggs in one basket. What you want is you want a layer and a layer and a layer. The top layer is high risk and high return. The bottom layer should be vanilla, and it should provide you with a very safe and secure return. That's how institutional investors work. They layer their investments. So I'm not saying, and I don't think we're saying, we don't feel in competition with Kenya in any way, shape or form. We couldn't. You've got some great returns here. But what we can provide is that secure layer, and that's what we're after supplying.
And I think Patrick would like to say something. Yes.
Give me this one. Yeah, you know, if you are an institutional buyer of property here, it's actually quite difficult to lay your hands on first-class stock. If you've got, say, I'll talk dollars because it's easier. If you've got $10 million here to buy property for pensioners, it's extremely difficult to go out there and find and buy institutional quality property that is showing an adequate return. It's probably 7% at best, not 15%. Now, if you can't buy it, you build it. A shopping centre, an office block, or whatever. But when you build it, you've got to find tenants, and there is the development risk. And I think what we're saying is, here is a way of placing money that will avoid really an array of risks, which perhaps apply here at different levels at different times, but at the moment, somewhere near the top of the property cycle, maybe they're greater than you think, that's all. I don't have a crystal ball either.
My name is Joshua from Home Africa Limited, a real estate company.
Yes.
And mine is on the business model. It seems heavy on the government occupying those properties and not owning them. Our DNA, like you said, has a different stream where we own the property. And the government, being run by those Africans, tends to want to own the properties they are occupying. How would that fit with your model where the government, say in the UK, is keen on leasing as opposed to owning?
Did you get all of that? So Joshua's from Home Africa, and he's saying your model is very it's government loaded. Essentially, you want the AAA credit, and that's why it's government loaded, right? I mean, that's the covenant that you're after. But he's asking that here in Africa, where land ownership is in everyone's DNA, governments tend to hold and own their property. And he's just asking about that, and do you see that changing?
No, at the moment, the vast majority of the space occupied by the government is owned by private sector landlords. That's institutions, individuals, family trusts, etc. Now, it's very unlikely that government's going to go back and buy those capitally back in again, because that would require an enormous infrastructure cost for no real return. So they continue to use the model that's worked for them for years, which is they continue to pay rent. So in the UK, the vast majority of government-occupied buildings are owned by the private sector. That's where the majority of buildings are. Other than really strategic ones, and then like Downing Street is probably owned by the government, you know. A Ministry of Defence because of those reasons.
But it's interesting here, just to come back to your point, is that we're seeing much more of what I would call the leasing model, which is what the UK government is really using, right? When you think about it, it's freeing up capital, it's not sunk into real estate, and you're paying a sort of rental charge. For example, recently the cars that the government leased. So you're seeing even us go more towards a leasing model because of this exact problem, that you're then getting too much capital stuck. And so I think it's just a point to make that I don't think it's going to remain like that forever. I think the government will need cash, and they will use this sort of vehicle, this sort of structure to release cash.
But in any case, why St. Paul's? St. Paul's, I think we were very lucky to get the name, first of all, and to actually get the name St. Paul's Property Trust was helpful, to say the least, because it does, I hope, give some feeling of comfort to what actually our aims are. St. Paul's was built by St. Christopher Wren, one of the UK and England's most incredible architects. It is huge. It only got one bomb in the war. So we'll probably only have one property here. It is extraordinarily institutional. It does, I hope, give the feeling which we want to give you of strength, security, and frankly, I can remember it. Not much of a good answer, but there you are.
Thank you. My name is Miano Dennis. Just two quick questions. Why Kenya? Did you choose Kenya to list? And are you going to replicate the same model probably in other markets, probably in Africa? You know? And the other one is when are you planning to do the actual listing in the NSE?
Just about why Nairobi, I think, again, we've seen a lot of innovation in Nairobi. I mean, whether we've seen the gems market develop, we're getting the derivatives market, we're looking to launch ETFs. And I think, all of us as Kenyans have got a dream that we want to be the financial market space in this part of Africa. We need to be the conduit to this region, right? If we are really going to be a hub, we need to be a financial hub. And I think this is a great statement of confidence by St. Paul's in the capacity of the Kenyan capital markets, beyond the connection that we're talking about between the UK and Kenya, and the financial exchanges. The UK, as you all know, is the biggest investor in the Nairobi Stock Exchange. If you just add up Vodafone, Diageo with the ABL, Barclays, well, we'll see what happens with that. But the point is, I think it's a testament to Kenya, in my opinion, and you can correct me if I'm wrong.
No, I think you're absolutely right.
Yeah,
and I do feel, I actually said in my opening statement, I don't know if you were here, that I really genuinely believe that Nairobi will become, and there's no reason why it shouldn't become, the financial hub for Sub-Sahara and dilute the influence of both Johannesburg and Lagos. And, to answer your question, are we going to do it somewhere else? The answer is no. We have chosen Nairobi as the center of influence and the place that we want to launch from. We feel that there is an attraction in fact, we know there's an attraction from some of the large Ugandan institutions to invest possibly in St. Paul's. We've tested the market there. And that doesn't mean we're going to have a listing on the Uganda Stock Exchange. They will have a currency risk, of course, between the Uganda shilling and the Kenya shilling, and then again from the Kenya shilling to sterling. But no, the answer is we are not. We will be focused here in Nairobi.
Let me try not to give another really bland answer to the question on timing. I'm sorry that we can't put a specific date on the IPO. The reason for that is we're still in discussions with regulators, as I mentioned before, to get the optimum structure for this. Regulators hate being put under pressure by me telling them what the date is that they need to give the sign-off and approval for. So I'm going to try not to be stupid enough to fall into that trap. However, we're going to try not to make everyone wait very long. I know everyone's keen to open up their checkbooks and get involved in this, so we're going to try not to make everyone wait long from here.
Thank you. I'm cognizant that we're now up against 12 o'clock, and I wondered, Richard, if you just wanted to add any final comments, and also to tell the audience that if you're interested in interacting with any of the folks on the panel, please take that opportunity once we shut down. But Richard, did you want to leave with any final comments?
No, you've exhausted me. Some incredibly good and very useful questions. I'm going to put them in my back pocket in case I'm asked them again. But thank you all very, very much for taking so much of your time out today. I hope you've enjoyed it. I hope we've shown you something slightly different. I hope you will find it progressive. And I hope you will find it as an alternative investment which will add value to your long-term portfolio and your portfolio strategy, particularly some of the professionals here who act for their clients as advisors. But there are an awful lot of, I can see, high net worth individuals here who make up their own mind, and quite rightly so too. Seriously, thank you very, very much indeed, and it's been a pleasure to talk to you.
Makofi, tafadhali. I'd like to thank all three of you for being such an engaging panel. Not sitting on your chairs and getting up, that's a first. Really appreciate that. And I'm grateful for the deep insights that you've given us into something that, you know, we're all passionate about, whether it's a shampoo or a house. Or I was at this presentation that we both attended, Knight Frank, and they were saying that, you know, the first destination for anyone who has money, surplus money to invest, remains the United Kingdom. And I think this is really an opportunity. This is not an opportunity to go and hit the ball out of the park and maybe run out of the park with the ball. This is a very solid opportunity, I think. And I think that when you look at it against UK government bonds, when you look at the dividend arbitrage, or however you want to characterize it, I think it's giving you above normal returns without the risk. And plus, you've got folks who've been in this business for years and years and years and know it inside out. So I'm really grateful for the opportunity that you gave us to come and listen to you. And we wish you every success. And, you know, I think this too is a testament to the developing real estate sector in the capital markets. I mean, the very fact that Kenya is able to put together such a thing, to list such an opportunity is a big testament to how much we've progressed in our capital markets. And I feel good about that. Thank you.
Thank you.